A trader wins 70% of their trades. Another trader wins only 30%. Who makes more money? The answer might surprise you. Because the 70% winner is going broke, slowly but surely. While the 30% winner is building wealth, one calculated bet at a time. This is the paradox that separates systematic traders from gamblers. And it all comes down to one mathematical concept that most traders never truly understand: expected value. In our foundation series, we've covered how much you can lose with the 1% rule. We've explored how much you should bet with position sizing. Today we answer the most fundamental question in trading. Is this bet worth taking in the first place? Quick question before we go deeper. Have you ever won most of your trades, but then a few losses suddenly erase the progress? Share the challenge you're facing in the comments. Our strategist will reply with a framework that helps you move forward with more clarity. Now let's look at the math behind why this happens. Expected value is the probability-weighted average of all possible outcomes. In trading terms, it's what you would earn or lose on average if you repeated the same decision infinitely. The formula is straightforward. Expectancy equals win rate times average win minus loss rate times average loss. Let's make this concrete with an example. Imagine a trading strategy with a 60% win rate. When it wins, it averages 2% profit. When it loses, it averages 1% loss. The calculation: 0.6 times 2% minus 0.4 times 1%. That gives us 1.2% minus 0.4% equals plus 0.8%. This 0.8% is the strategy's expectancy. It means that over many trades, each bet is theoretically worth 0.8% of your capital. Not just the winning trades, every single trade, even the losses. This is where the mathematics become profound. Now here's where most traders go wrong. They chase win rate. They want to be right. They want to feel successful on every trade. But win rate alone is meaningless. Let me show you why. Strategy A has a 70% win rate. Sounds great, right? But when it wins, it makes $50. When it loses $200. The math: 70% times 50 minus 30% times 200. That's $35 minus $60. Negative $25 per trade. This trader wins 70% of the time and still loses money. Now consider strategy B. Only 30% win rate. 7 out of 10 trades lose. But when it wins, it makes $300. When it loses, only $100. The math: 30% times 300 minus 70% times 100. That's $90 minus $70. Positive $20 per trade. This trader is wrong 70% of the time and makes consistent profits. This is the win rate paradox. It explains why the greatest traders in history often have surprisingly low win rates. Trend followers typically win only 35 to 45% of their trades, yet they've generated billions in profits over decades. Because their winners are 3, 4, 5 times larger than their losers. The question isn't how often you win. It's whether your system has positive expected value. Subscribe for systematic trading insights that improve real trading results. And if this brought clarity, share the video with a trader who will benefit too. So how do you know the minimum win rate you need? There's an elegant formula. Break-even win rate equals 1 divided by 1 plus your reward to risk ratio. With a 1-to-1 reward to risk, you need 50% to break even. Simple. With 2-to-1, you only need 33%. With 3-to-1, just 25%. With 5-to-1, only 17%. This is why asymmetric setups are so powerful. Design your trades so that wins are multiples of losses, and suddenly you don't need to be right very often. Michael Burry's famous bet against subprime mortgages exemplifies this. He was wrong for years, paying premiums, looking foolish. But when he was right, the payoff was enormous. His win rate was low. His expected value was astronomical. Van Tharp, one of the foremost researchers on trading performance, introduced a framework that makes expectancy actionable. He calls it R multiples. R equals your initial risk per trade, the distance from entry to stop loss in dollars. Every outcome gets expressed as a multiple of R. You risk $100, you lose 100, that's negative 1R. You risk $100, you make 200, that's positive 2R. You make 500, positive 5R. This standardization is powerful. It removes dollar distortion. A $1,000 win on a $100,000 account means something different than on a $10,000 account. But a 2R win is a 2R win, regardless of account size. Van Tharp's research revealed something remarkable. Position sizing explains 90% of performance variation among professional traders. Not entry signals, not market analysis, not prediction accuracy. How they size positions based on their edge. But here's the key. Position sizing amplifies edge. It doesn't create it. Without positive expectancy, no position size is optimal. You will eventually lose everything. He developed a metric called the System Quality Number, or SQN. The formula, square root of the number of trades times expectancy divided by the standard deviation of R multiples. What does this capture? 3 dimensions. Is the system profitable on average? How consistent are the results? And how many opportunities does it generate? The rating scale is brutally honest. Below 1.5, probably very hard to trade. 2 to 3, good system. 3 to 5, excellent. Above 7, Tharp calls it holy grail territory, almost never found. Most traders overestimate their system's quality. Calculate your SQN honestly. If it's below 1.5, you don't have a position sizing problem. You have an edge problem. Now, there's a critical bridge between theory and reality. The law of large numbers. It states that as sample size increases, the average converges to the expected value. This is the bridge. It's how theoretical edge becomes realized profit. But it requires patience. 10 trades, high variance, meaningless statistically. 30 trades, patterns emerge. 100 trades, reasonable confidence. 1,000 trades, high confidence expectancy manifestation. This is why casinos always win. Not on any single bet, but across millions of bets. Their edge becomes certainty. We want to be the casino. Trade with positive expectancy. Size appropriately. Let the law work over sufficient sample size. The danger is abandoning a winning system during an inevitable losing streak. Even a system with 60% win rate will have sequences of 5, 6, 7 consecutive losses. That's not failure. That's variance. This brings us to the most profound reframe in trading psychology. The invisible payout. Alexander Elder said, "Losses are an inevitable cost of doing business." But most traders see losses as failures, as setbacks that push success further away. From an expectancy perspective, that's fundamentally wrong. If your system has positive expectancy, every rule-following trade moves you closer to success, wins and losses alike. Remember our earlier example? Plus 0.8% expectancy per trade. That means every trade you take earns you an invisible 0.8%. whether it wins or loses. The winning trade makes it visible. The losing trade keeps it invisible. But both bank the edge. This is the mindset shift that separates professionals from amateurs. You don't ask, did I win this trade? You ask, did I follow my positive expectancy system? When your system is always working, regardless of individual outcomes, trading becomes what it should be. A systematic extraction of edge from market inefficiency. We've now completed the foundation. Video 1, the 1% rule. How much can I lose? Survival. Video 2, position sizing. How much should I bet? Growth optimization. Video 3, expected value. Is this bet worth taking? Edge validation. These 3 pillars form the complete foundation for systematic trading mastery. Without positive expectancy, no risk management saves you. You're rearranging deck chairs on the Titanic. Without proper position sizing, even positive expectancy gets destroyed by variance. You blow up before the math works. Without risk management, one bad trade ends everything. Survival is the prerequisite. All 3 work together. Expectancy creates edge. Position sizing optimizes it. Risk management protects it. So here's your action step. Calculate your last 30 trades. Determine your win rate, your average win in R, your average loss. Apply the formula. Is your expectancy positive? If yes, you have edge. Now optimize with position sizing. If no, stop trading that system. No position size fixes negative expectancy. Trading isn't about predicting the future. It's about finding positive expectancy and exploiting it systematically. We're building a community of traders who think exactly this way. Probability over ego. Discipline over impulse. Join us at risk1reward3.com. Link is in the descriptions. It's free. Think in odds. Act with discipline. See you in the next one.